OG Macro AG here. Today we're going to slow things down. No hype, no excitement. Just data, structure, and probability. Because when silver moves 22% off a major low, the question isn't whether it moved. The real question is why it moved, and whether that move actually means anything. Markets are emotional in the short term, but structure always wins in the end. And right now, silver is sitting at the intersection of liquidity stress, leverage unwinding, and physical supply tension, a place where false bottoms are common and real turning points are rare. So let's walk through this carefully. Silver collapsed to the $65 area, a level that shocked a lot of participants, not because it was technically impossible, but because of how fast it happened. The decline wasn't gradual. It wasn't orderly. It was violent, liquidity-driven, and forced. That matters. When markets fall slowly, that's distribution. When they fall fast, that's usually leverage breaking. Within a compressed window, silver dropped over 40% peak to trough, then rebounded 22% almost immediately. That combination, sharp collapse followed by an equally sharp bounce, is not the signature of a healthy market. It's the signature of stress. And stress doesn't disappear just because price bounces. Let's be very clear here. This bounce did not happen because fundamentals suddenly improved overnight. It did not happen because monetary policy changed. And it did not happen because the macro environment became safer. This rally happened because selling pressure temporarily exhausted itself. There's a big difference. Here are the drivers: margin calls across futures and options, forced liquidation by leveraged funds, cross-asset selling from equities, and crypto liquidity being pulled, not offered. Once that forced selling pauses, even briefly, price snaps back. That's mechanical. That's not bullish. In stressed markets, the first bounce is almost always violent. It catches shorts. It relieves pressure, and it convinces people the worst is over. Sometimes it is. Most of the time, it isn't. Let's put emotions aside and talk structure. Silver collapsing to $65 wasn't random. It coincided with long-term trend support failure, multi-year moving average breaks, volatility expansion beyond historical norms. That alone tells us the market regime changed. The rebound to the low 80s range, roughly 22%, brought silver back into previous congestion zones, not into strength. Key observations. The bounce stalled below broken support, volume expanded on the decline, not the rally, volatility remains elevated. In other words, this move relieved pressure, but it did not repair damage. In healthy bottoms, you see volatility contraction, time spent building value, reduced downside momentum. We don't have that yet. This is the part most people miss. Silver didn't crash because demand vanished. It crashed because liquidity did. When liquidity disappears, price doesn't reflect value. It reflects urgency. Across markets, we saw Treasury volatility spike credit spreads, widen funding markets, tighten risk parity funds, de-risk. When that happens, metals don't act like safe havens. They act like sources of liquidity. Silver is especially vulnerable here because it's volatile. It's heavily paper traded, it's used as collateral, so when stress hits, silver gets sold, even if long-term fundamentals remain intact. That's not a silver story, that's a system story. Here's where things get interesting. While paper silver collapsed and rebounded violently, physical markets did not follow the same script. Premiums didn't collapse. In some regions, they widened. That's critical. In Asia, particularly Shanghai, physical silver premiums remained elevated relative to paper pricing. What does that tell us? It tells us that price and availability are diverging. Paper markets trade leverage. Physical markets trade supply. When those two disagree, something eventually has to give. But, and this is important, divergence does not tell us when. It only tells us where pressure is building. Let's talk inventories. COMEX silver inventories have been under persistent pressure, not collapsing overnight, but steadily eroding. Registered stocks remain thin relative to historical norms. Eligible metal exists, but it's not necessarily for sale at current prices. LBMA Vault data shows similar trends. Less freely available metal, more metal tied up in financing structures, slower turnover. This doesn't mean default, it means reduced elasticity. And in stressed systems, reduced elasticity amplifies volatility. That cuts both ways. The gold-silver ratio spiked aggressively during the crash. That's normal. In risk-off events, gold outperforms silver because silver has industrial exposure and higher volatility. The key question now is whether that ratio stabilizes or continues to expand. If the ratio holds elevated levels, it tells us risk remains dominant. Growth expectations are weak, silver remains vulnerable. If it starts compressing slowly, not violently, that would suggest stabilization. We're not there yet. Silver didn't move in isolation. Crypto experienced liquidation cascades. Equities sold off in high beta segments. Volatility rose across asset classes. That tells us this was systemic, not sector-specific. As long as equity volatility remains elevated, crypto remains unstable. Funding markets stay tight. Silver will trade as a risk asset first, not a monetary metal. That's the environment we're in. Zooming out. Debt levels remain extreme. Fiscal discipline is absent. Central banks are constrained. The Federal Reserve faces inflation that's sticky growth that's slowing financial markets that are fragile. That combination is unstable. Policy uncertainty doesn't create clarity. It creates volatility. And volatility is poison for leveraged paper markets, which brings us back to silver. Let's talk scenarios, not predictions. Bearish continuation scenario. Liquidity tightens further. Equities roll over again. Silver fails to reclaim broken support. Retest or undercut of lows becomes possible. This scenario assumes stress is not resolved, only paused. Bullish stabilization. Scenario volatility compresses. Time is spent building value. Physical premiums remain firm, ratios stabilize. This scenario requires time, not excitement. Real bottoms are boring. Fakeouts are fast. Going forward, the focus should be on volatility, not price inventory trends, not headlines, ratios, not narratives, liquidity conditions, not opinions. Markets don't turn because people hope. They turn when pressure dissipates. Silver's 22% rally off the lows is important, but it is not definitive. It tells us stress hit a breaking point. It does not tell us that stability has returned. The system is still fragile, liquidity is still selective, volatility is still elevated. That means humility matters. Stay sharp. Watch the data. Think independently. OG Macro AG out.